The Kenyan shilling has defied forecasts by analysts that it would take a beating and remained largely stable over the last 1 year. But as Victor Kiprop reports, this stability hasn't come without doubts by stakeholders who believe the currency is being managed.
Ideally, a free-floating exchange rate regime is where the value of a nation's currency is set by the forex market based on the supply and demand forces relative to other currencies. The Kenya shilling has averaged between 100 and 103 shillings to the dollar over the last 1 year, but institutions such as the International Monetary Fund and local brokerage firm Amana Capital, however, believe it is overvalued by 17.5% and 30% respectively.
Ideally, if you look at the three fundamental economic principles on valuing a currency, the shilling should not be at 100. Then the government can come and say, oh yes, we should be higher or lower than that, but we are at 100 because of 1, 2, 3, 4, 5.
In its report released late last year, the IMF cited the country's current account deficit, which it said was not in step with other economic fundamentals, while Amana cites the devaluation of purchasing power, which it says is at 50%.
When you see the evidence being produced, you can see that clearly there's evidence of the fact that the shilling is actually free-floating, because you can see the kind of inflows, the strong inflows that are supporting the shilling where it is, and we see it moving whenever there is a change in the current account. So I think these are things that we should be able to rationalize and explain to the general public.
The Central Bank of Kenya maintains that the shilling is properly valued and that the IMF used an EBA-light methodology which is meant for more advanced economies. Victor Kiprop, NTV Business.